Right, another week and another rough week for risk. We did sustain a rally for a bit of time and then ran into some resistance at some technical levels, and then we got more tariff fears and more AI build-out fears. Uh, Asset prices are building in more recession risk, so I'll show you some of those. It's broadening out in terms of the market starting to discount things. It's been the worst month for credit since 2022 with 1 day left. Sentiment continues to fall. I'm going to bring up the fact that to me now it's starting to become a little bit more clear on what the new macro regime is going to be. So I'll go through that in the final half and just highlight my views on what's going on. And I think you have to keep in perspective that the administration is going to be running these policies for the next 4 years. And when I say those policies, I think uncertainty is going to remain. They're going to focus on making sure they win the AI arms race. The tariffs at this point are real, and the question is only how much are they going to do. I still do not believe there will be really any chance of a recession. We could have a quarter or two of negative GDP, but again, recession for me is when we're going to lose a significant amount of jobs, and it's going to take time to find new jobs. So when you go through the whole thing, you're looking for what the market is doing, and it is definitely repricing multiples on technology, software, and the Mag 7. And at the same time, it is rotating money into the themes that I think are the strongest, and I'll go through those. The power needs, again, continues to be a theme that I've talked about really since September, October. And the other thing is the rise of the inefficiency. This is the macro regime that I think is taking place, is the need for the embodiment of AI, the build out of the data centers, everything that's coming over the next 5 years, regardless of whether NVIDIA sells all the chips or the multiples on those stocks go down. And then the inefficiencies I'll spend some time on in terms of companies that have tremendous cash flow, have steady revenues, but are going to benefit from AI adoption. And then I'll finish off with Custodia Bank and what went on with the first stablecoin. In terms of just what happened last week, this is the S&P 500 chart. And if you look at this and you go through it, we failed exactly where we should have. So the gap up that we had from the election, we went back down to that day before. The lows that we had for the year before we started to sell off in February, and the 200-day moving average. So everything failed there. When you get failures at technical levels and they now used to be support and they act as resistance, that just shows that right now the market is in a downtrend, and you're going to need some positive catalysts that I think are related to tariffs at this point to actually get it to find a sustainable bid. But I think the administration doesn't want the market to go higher, as I said last week. So I think you're going to run into these things, even if we go down, retest the lows, and then bounce back. In terms of the Mag 7, it was the 6th week in a row that we were down. We did 7 in a row back in 2022. That was actually fairly close to the lows of the market. We went back and retested again. But it's been 6 weeks in a row. So again, we're oversold. We're going into that April 2nd period. I'll go through the sentiment. People are very negative. So I think as we go into it, a retest of the lows, possibly even taking out the lows, maybe another bounce from there, depending on what goes on with the tariffs. Any positive news, again, because of how negative, will get you another short covering rally. It's still a rotation. So this is the S&P cumulative breadth. You can't even tell that anything is going on. We're basically at the same level we were at the end of January, and we've just gone sideways. So again, I'll keep saying it. It's a rotation, but the auto tariffs got us to sell off a little bit on Wednesday, and then the focus shifted, and again, more and more rhetoric from the White House, particularly Trump again, that they're going to keep pushing on this regardless of what happens. And this was a story out today, this morning. Trump pushes aides to go bigger on tariffs as key deadline nears. We have no idea how much of this is negotiation, but the reality is the uncertainty that it's creating makes it impossible to take a long-term position on the index itself. The rotation continues to go on, but as I'm going to go through, we've actually seen some shifts that it's starting to spread a little bit more. A lot of bad news for NVIDIA this week. You had another article from TD Cowen on Microsoft canceling some data center projects. Again, this should not be surprising to anyone, but at this point, any bad news is bad news. You had CoreWeave having to lower its IPO down significantly from where it was expected. In China, you've got a lot of stories floating around that Chinese chips are making some headway, and they're still behind NVIDIA, but you're starting to get more and more stories outside of China about breakthrough using Chinese chips. So all of this went on. You also had Joe Tsai from Alibaba warn of a bubble in the AI data center build out. So another one saying they're probably overbuilding. And then out of China, they put in some new energy efficient rules that could block H20 chips in new data centers. So again, all of the orders in China, there's just more fears in terms of what's happening with inside NVIDIA. And I think what the market is showing you is there's really no room for bad news with these guys spending money anymore. And that's kind of the theme, is I think people are starting to recognize post DeepSeek, with all this news coming out, that regardless of what the revenues are now, regardless of what they're doing, we have lost the speculative nature of AI in terms of the hyperscalers and NVIDIA for a very important reason, because if you're going to value things 4 years out, meaning 4 years of Trump, 4 years of a possible trade war, 4 years of uncertainty over the AI build out, and 4 years of just no room for error in terms of the multiples, I think they're building in that uncertainty into the prices, and that's why we're seeing a multiple compression in the highest multiple names, and you're seeing rotation from those extremely large names into other places. Consumer expectations came out, the Conference Board consumer expectations. We're at levels now associated with kind of a recession. So, whether it's in here recession, whether it's recession here, we had a period in 11 when we thought the EU was going to break up, and then subsequently in 2013. But the reality is we're back down to levels in consumer confidence where people are uncertain. There is a political side, but as I'm going to show you, this is spreading more and more. With the data we had on Friday in terms of real spending, you've taken the Atlanta Fed GDP number now for the first quarter down to minus 2.8. So we're still, people can go through the gold imports and get this back. You're talking about a number somewhere near zero, somewhere minus 0.5 to plus 0.5. So we're having a weak quarter. I wanted to overlay this with 10-year rates because one of the things that has been, I think, a big negative at this point for what's happening in the White House. If they were orchestrating to get weaker GDP, well, they're clearly getting it, even if some of it is not related to Trump. It is just kind of the first quarter with weather and California. But 10-year rates are just not falling. And the problem is if they have a quote-unquote bond put out there, the stock market is back down again to levels seen in September, mid-September. We've got the 6-month rate of change now negative, and bond yields are up 60 basis points since last September. So they're not getting what they want. In terms of just the health of the market from a recession perspective, the white line here is the equal weight consumer discretionary versus staples. It broke through, barely, but broke through the lows that we made back there. So this is saying, again, that the market is rotating away from anything related to growth. And it's moving into things which have some kind of stability. 6-month rate of change on the S&P. If I had to figure out a recession model at this stage, at least one that would have the highest probability of having 2 quarters of negative GDP with just 2 indicators, I would want the S&P 500 rate of change. I would, the 6-month over 6-month is a very good warning sign for recessions. And then the second one would be the jobless claims. We haven't seen jobless claims go up at all. We now have the S&P 500 at the largest negative 6-month over 6-month since early 23. The reason this is important, just so everyone gets it, rate of change, this means that we are lower than we were 6 months ago by 2.4%. So this is not something which just started in January at this point. We've done enough damage in the market that this is way back. To show this is this same number, 6-month rate of change. The orange line here is the G10 City Surprise Index. So this has been happening with the City Surprise Index actually near 15-month highs in terms of, again, City Surprise Index is just the G10 numbers are actually beating expectations. You wouldn't expect the S&P to be down here, and that's one of the reasons why at this point, as things worsen, you got to be a little bit more concerned as we approach the lows that if he's going to go full boat on the tariffs and he's actually going to do enough to where people take GDP down seriously, even if this is still a negotiating tactic, the market is now weakening at a pace where you're going to see more and more people take off risk because I think there's a no moss mentality that's entered and it's showing up in credit. So this is the high yield OAS, option adjusted spread. We broke through the March wides, and we are now moving faster. I wouldn't worry is now where we are relative to these times in history. This can happen very quickly. You can go to 500. There's no liquidity. So if this moves, which again, it's starting to kind of have that parabolic feel. If you look at this one, this was kind of a 3-day move. This has been going on now for a period of time. The last time we saw anything like this was back here. And so you're kind of looking for something to happen on the tariff side to make people get a little bit better. I just don't think there's anything on the economic side that's going to end up surprising on the upside, and I don't think the earnings side is going to surprise on the upside either while we're going through this tariff. So you're going to need some kind of a positive catalyst out of the White House to get through this negotiation and not turn it into a trade war. And I think at this point, most people are worried about a trade war, and you're starting to see trade war pick up in terms of the sentiment. This is the biggest monthly widening in credit. We're up 51 basis points on the high yield OAS. Last time we saw this was again near the lows in June of 22. So we are getting a lot of movements on this in terms of people getting worried. This is the consumer confidence percentage of people surveyed that believe stocks will increase over the next year. This is for the quarter. This is the worst drop in a quarter basically in history. This goes all the way back to the beginning of it in 1987. And you can see the periods in time where we had more. These are during extended bear markets. This is 1990 during the recession. This is year 2 into the market peaking and going down. This is the great financial crisis. So you've had a huge move lower in terms of expectations of stocks going higher. And if you take it relative to increases versus decreases, well, now you have more decreases than increases. So we just had this massive drop off in 1 month. So the sentiment on that has worsened. And then if you just look at what's happening on the uncertainty index, it just continues to move higher. And here it is related to the S&P 500 20-day realized vol. So the one thing I will say is, as this has gone higher, 20-day realized vol has viewed this as he's not going to do this. He's not going to go full in. And again, that's where I think the risk is in the marketplace, is that people may be underestimating how much tolerance he has for the market to go down before he goes. At this point, we're back down towards 10% off the highs. I definitely think, as I said, that you could see in a scenario where he decides to let this go further. I think it could quickly get down to 5,000, which would be another 10% from here and take us into the down for the year close to 13-14%, and more importantly down about 20% off the highs. So if this week goes through and if he's got higher than expected tariffs on kind of the scenario where we're going to have a tariff rate that is up above 10%, I think the market is just at this point going to reduce risk even further, having no certainty as to when this is going to end. At the same time, I bring this up because Elon Musk did do an interview this week with Bret Baier, and he said he's absolutely going to be able to reduce the deficit by $1 trillion before he leaves at the end of May. That's a big statement. If he's able to cut that much, it says two things. One is, what is the economic impact from that? He says it's not going to be, the money's going somewhere. So unless it's sitting somewhere or they're just clearing up some stuff that it's not really actually going through the economy, it's going to leave the economy. And so there's going to be an impact. So there's one side is the economic. The second side I'll get into a little bit later as part of the rest of it. In terms of the Dallas Fed Energy Survey, this came out this week. I think this is really interesting. This is obviously in Trump country. This was in the comments section of that Dallas Fed Energy Survey, and I just want to highlight some of these. The keyword described so far is uncertainty. There cannot be U.S. energy dominance and $50 per hour. Those $50 per barrel oil. Those two statements are contradictory. At $50 per barrel oil, we will see energy production start to decline significantly. This is not energy dominance. The administration's chaos is a disaster for the commodity markets. Drill, baby, drill is nothing but a myth and populist cry. I've never felt more uncertainty about our business in our entire 40-year career. The only certainty right now is uncertainty. With that in mind, we are approaching this economic cycle with heightened capital discipline and a focus on long-term resilience. Even in Trump country and oil, where we're supposed to be a big positive, where we have tremendous power needs, the sentiment is uncertain and people are not happy about the trade war at this point. You had Javier Blas, who writes for Bloomberg, was at CERAWeek, and he basically said the mood at the annual Jamboree with 10,000 executives should have been ebullient. It wasn't. Executives far more worried about Trump's push for lower oil prices and the potential of a trade war-induced recession. So, again, I don't know how to say it. Right now, the market is rotating. We're heading back towards the lows ahead of April 2nd. If we get something that is anywhere in line to clear, I do think the market will bounce because I don't think we're going to have a recession. I think people just want the rules. So don't get all worried about the tariff situation. But at the same time, the market is weakening and we know there's losses out there, and you could get more liquidations if all of a sudden credit continues to widen because people increase the recession risk. And that's where we are at this point, is the stock market now is trading off recession risk. And if recession risk increases, the stock market has to go lower to represent it, and that would be seen through credit, which has now already taken out the wides, while the S&P has not taken out the lows. We're finishing up a quarter right now. We have 1 day left, where S&P relative to the world, ex the U.S., is having its worst quarter in the last 30 years. So the rotation goes on. One thing I think is important, this is the DAX. Again, you can't see the top of the chart. Now you can. Rate of change here is about to turn negative on the 50-day as well. So we've been above the 50-day the entire time since November, since the election. Now we're back below it. I bring that up again because if we start having recession risk in the U.S., the reality is for everybody, if credit starts to weaken, then the global economy starts to weaken. If the U.S. is if fears of recession, it's going to spread throughout the globe and nobody will be safe, and you'll start to see everything start to break lower. That's what the next phase would be, and that's where we're at, and that's what the market is starting to show. So I think it's a big week for trying to find some stability rather than try to guess what he's going to do. Again, I think we're going to be in this kind of uncertain environment for at least the next 3 months. And anyone trying to pick a bottom at this point, I think you're going to run into resistance above. We need to see something change here other than just some positive short covering days where we get breadth thrust. We actually need to see the Mag 7 starts to stabilize somewhere. They are down 16%, so that could happen at any point since their earnings are still forecast to be good. But the rotation continues. So this is where I want to segue into just what I think is happening. So again, I've focused. Market's now down 5.11% year to date. It's pretty much all the tech names. So this is the Mag 7 right here. And then everything else is up. Industrials have now kind of sunk to the negative. Materials are barely up. Energy, healthcare, utilities. These are power for AI. The energy sector and the utility sectors are names that have cash flow. They're going to have cash flow because the energy needs are going to go higher. Nat gas is going higher. So with oil down, you still have these doing well. This is a structural play that I think is in the midst of a regime shift. These, to me, their valuations, again, I think the AI build-out fears will remain for the foreseeable future, and I actually think you can make the argument that 3 years from now, because AI is moving so fast, so you don't know what is going to be necessary for companies like NVIDIA, but you also have the competition from China, and if NVIDIA has those uncertainties, then all of these names have these uncertainties from a spending basis. Financials has the deregulation tailwind, which I think will keep it there, and then healthcare is part of this inefficient thing, which I'll show as we get through, but I think that's the structural change. In terms of the hyperscalers and the main issue, and I want to bring this up because every time Microsoft has any data center things, it becomes an issue. Nadella was very, very clear on the Dwarkesh podcast that he doesn't believe in an AGI milestone, which means he's not interested in chasing for the AI god and building stuff out without any concept of what it'll look like 3 years from now. He's not interested in that. He wants to deal with the applications. He wants to deal with other parts of it and not be involved in this spending money at any pace over the course of the next few years. He does believe that compute is still a major theme and will be necessary, but he believes, as he says here, that you're going to have something that's commoditized, so why should you go jumping in and go through it? So it says he did say, well, he didn't say that his company will stop building data centers. And remember, they just started 3 Mile Island. So I think all the fears on this that keep coming out should not be a surprise. And if you haven't listened to that interview, it's absolutely something you should listen to in terms of going. But I think Nadella revealed that by 27, 28, Microsoft plans to lease much of its computer power instead of building more itself, which means they're still building now. So don't doubt the needs of the data centers. Don't doubt the build out. Doubt the fact that the valuation shouldn't be there. So at some point, if NVIDIA actually in the second half of the year is beating numbers, you will get a bounce. I just don't think you're going to see the 50 to 100% type upside, even if the earnings come through much better than expected. I think they can grow somewhat with earnings, but I think the bar is shifting, and I don't think people are going to dive back into these for a lot of reasons. I think this is a regime shift. I think this is 17 years of a software boom where U.S. dominance was there, and now we're in something that over the course of at least the next 5 is going to shift more towards things that have been left for dead, that have lower multiples, still have tremendous cash flow and steady side. But if we're going to be in a period where we're trying to get the deficit down to 3%, that's not the same as when we took the deficit up to 7% and we were spending. And remember, the debt in 2007 when the iPhone came out was $9 trillion. Now it's $36 trillion, and we're focused on it. More news on tech giants need to stop racing to build AI gods. I think you just have to keep this in there. I think investors are doubting it. OpenAI, $125 billion dream. Still not expecting to be profitable before 2029. This is not the same environment as it was during the 2010s when Amazon could get away with this consistently and continue to grow. As much as I love AI, OpenAI has not been able to show a way that they're going to be able to charge people more money. They have a dominant market share, but if that company is not able at this point with the best product, and charging the most money, and they're not able to say they'll be profitable by 2029. It's a very scary thing, and they seem to be dedicated to the race for AGI. Jensen Huang made it very clear this week that China is his biggest fear. And I think that's going to be there. I don't think that's going away. There's so much ascension by China each week, whether it's the chips, whether it was DeepSeek out of nowhere, whether it was Manus on the agent side. They are continuing to keep coming, and I think that is a disruptive force. And that leaves us right here where the Mag 7 earnings, they're still forecast to be higher. The market is breaking down. So if the earnings are able to come in, the question is, will this go back up, or will we just be going sideways here on this basis? So I think it's important, and the reason is because their forward price to sale ratios are sitting up here. Here's the rest of the market. This is the S&P, and this is the S&P X, this group. So we're just at a point where the rest of the market may benefit more from AI adoption. And so any weakness on the profit margins, we're up at these levels. Again, X the Mag 8, Mag 7, whatever you want from them. We're just at levels that are extreme. You don't have the ability of missing numbers. My Substack from this week went through that next phase of AI from intelligence to embodiment. The humanoid, that will be a structural movement going forward. We're in a race for the hardware side. We're in a race for AI. That's not going to change. The administration is going to make sure of it. And so as I highlighted last week, this is Chevron relative to the S&P, total collapse relative to it. And now all of a sudden, this is moving higher. And I fully expect that Chevron will continue to do well. So far, it's doing well versus the Mag 7 coming down. But I just think you have to be aware of these companies that have just not been owned, and they're going to benefit from this. So let's get into the power side. This is from Goldman Sachs in terms of when they think we'll reach some kind of capacity situation, which is 26, 27. And if this is true, and all of a sudden we reach here, and then in 28 we're just not we're not in the same situation. You obviously have a scenario that should be built into the market at this point. We've lost the momentum of let's just pay for that, and we've moved in some other side, and I think that's because of what's going on with the administration in terms of the forward uncertainty. Growth in global energy demand surged in 2024 to almost twice its recent average. This is just to support what we've already done ahead of the increase in demand. Economic growth now depends on electricity, not oil. So we've moved to the electrification. Eric Schmidt put this article out at the end of December just on the need for energy for AI and AI for energy. And within there, he just said AI technologies, as they advance, their energy consumption is set to increase substantially, posing a risk of energy shortages that could hinder technological progress. He does talk about the fact that AI itself will enhance energy efficiency over time. And again, that's the way you should think about the chart of the next 2 years. There's a massive build out. Whether or not year 3 and year 4 that's going to be as necessary, it seems like this is really to get us up to speed on this. But that just means these energy companies are just going to have a tremendous amount of demand and the build out, and I don't think people have fully grasped how much we're talking about. Global energy demand rose by 2.2% last year. This was despite slower growth in China, where energy consumption rose by less than 3%, half its 2023 rate. So now you have China picking up. This was 2.2, faster than the average annual increase between 2013 and 2023. I mean, it's a very powerful statement to just say that demand is going up that much. Yes, it's mainly electricity, but it is happening. And remember, we still have a goal to reach net zero. Even if the U.S. isn't focused on it, you're still talking about requiring $75 trillion of investment. This isn't going away. And just to put like how much of a change this is, and again, why you should be thinking about this in a different perspective. So here we are, average annual electricity load growth, steady decline for 50 years down to here. Then it goes sideways. Nominal GDP is still growing, and we've become more efficient. And then all of a sudden in 2022, ChatGPT comes out. 2023, we get this increase. Now in 2024, we just went back above the 1990s levels, and this is expected to go significantly higher going forward. So this is real, and it comes at a time where technology is 30%, consumer discretionary is 10%, which is mainly Amazon, consumer communication services, which is other Mag 7 names, 10%. So you have about 50% of the weighting is now innovation or technology, and energy is 3.6%, and utilities are 2.45%. You just have a complete misweighting on the lack of investment and the lack of anything that's happened from the energy side for a period of, a good, since 2008. So it's been almost 20 years. In terms of AI and how the government is going to keep going through this, Secretary Wright leads AI collaboration event from Oak Ridge National Lab. This is a global race. There's just no way to stop it. Tech leaders warn against Manhattan Project race for AI superintelligence. AI quantum race keeps going with China. The robotics race with China keeps going. Eric Schmidt suggests countries could engage in a mutual assured AI malfunction. You just have to realize that everyone is trying to win this battle. And again, to win this battle means more energy. I don't see this changing with Trump's tariffs. I don't see a recession happening, which means the spend is going to happen. This chart looks great. We keep making higher lows all the way through here. We haven't been able to break out. We were making higher highs. I think the energy sector, as I've said repeatedly since October, is a must-have in your portfolio. There's a lot of ways to play it. Don't get fixated only on the gas side. Coal's being turned on. MLPs are doing fantastic. There's a lot of places you can go. I just think that they're going to benefit significantly from the power needs. This is why I want to bring this one back up again. Elon Musk is able to find $1 trillion for one reason and one reason only, because the government is arguably the most inefficient spending place, and a place that has just gotten so big with bureaucracy that any kind of savings will fall to the bottom line quickly. Same thing goes for healthcare. Healthcare may be number 2. So the reason the healthcare sector, in my opinion, is doing well is because over the course of the next decade, we will continue to have massive increases in healthcare expenditure. So if the government is trying to slow down overall GDP, nominal GDP. You want to go to the places that are going to continue to grow. And healthcare, because of the aging of the population, because of the health of the population, just continues to be a bigger portion of the spending. The reason it hasn't been in there, it's not sexy. This is not something that you're going to get, young day traders sitting there going, okay, let me go buy some of these names, unless they're biotech. This is kind of a boring period, which is why the DAX, which is why Intel, which is why Cisco, which is why McKesson, Cardinal Health, as I show you some charts. But generative AI in healthcare is absolutely happening, and it's a big deal. And so they're going to get a tremendous benefit. This is a McKinsey report. This is one of the pages from there. 64% have reported that they anticipated or had already quantified positive ROI, suggesting high expectations for Gen AI technology. We're looking for positive return on investments. We're not getting it from the hyperscalers as of yet. Maybe we will, but they're already priced with multiples that are 3, in some cases 4 times where the healthcare names are, and they've been growing revenues. Some of them are enormous in terms of what's gone on, and they've been incorporating AI. This is not something new. And here's how when momentum unwinds, here are 2 names in the healthcare sector: Cardinal Health, the white line, and the orange line is McKesson. Well, we have a momentum unwind. These seem like momentum names. They haven't budged. The reason they haven't budged is because they're making money and they're reasonably priced, and they're in that bucket right now where investors are looking for something where they're going to get the growth and they don't have to deal with multiple compression. And so here is the PE on the S&P 500, which got up here, driven by the Mag 7. We've obviously seen a correction in the market, and in particular, we've seen a correction in the high multiple names. And what you have here is you still have McKesson sitting at below market multiple and Cardinal Health sitting down here, and yet they've been producing significant returns in their price over this time. So these are not the kind of names that people are going to go jump into, but I think this is what's happening in the market. And as long as we're in a situation where there's no speculative juices alive, which I just don't see with the uncertainty, and it doesn't seem like this administration cares too much about allowing the speculative juices to go higher. That should be lower multiples, and you want to look for things that have been left for dead, and that money needs to shift from those names. If there's any bad news in the Mag 7, this rotation will continue. Obviously, the market will remain kind of around the unchanged to down on the year while this rotation goes on. But I think you, as investors, you need to kind of pay attention to what's going to happen over the next 4 years. I think this rotation is real. Eric Schmidt did this interview at Stanford. He was speaking in front of a class. And if you haven't heard it, I'm going to bring it up again. I brought it up on videos a long time ago. But in particular, I want you to read this. If TikTok is banned, say to your LLM, make me a copy of TikTok, steal all the users, steal all the music, put my preferences in it, produce this program in the next 30 seconds. That's the command. That is where we are. So if you haven't used Cursor, if you haven't used Replit, we can't do everything here yet. But the reason that it's starting to become hard for technology, we're entering the physical world. AI cannot replace the physical world. It cannot replace copper. It cannot replace oil. Yes, they will eventually have an impact, but that's what we're entering into, is the physical world and the virtual world are merging. And any software is up for competition as AI gets better and better. So looking out 3 years, if TikTok is banned, say to your LLM, this is already here. It may not be able to do all of this yet, but with the agents coming and this stuff accelerating to the pace that it is, you have no ability to build a moat around your company. So if you're a really big company, you're at risk for getting under pressure. And I think that's what's being built in. It's not now, but the multiples going forward, yes. So here's CRM. This is Salesforce. So again, in the technology side, they have good news. Their peak actually happens on earnings news. They fall down, they get a bounce back up, and now they've just broken down. They went back to the 200-day. They're going lower. There's another one where anything that's a software, big software company, even though they've already made inroads into other companies, they're trying to get their AI agents. This was supposed to be a big AI agent theme for this year in terms of one of the companies, and it's not happening. And part of the reason is, here's where their multiple was. They were in the 30s. So again, this whole multiple thing. And then down here, Cisco, another boring company, sitting near all-time highs, continues to outperform, does cyber, is involved in the data centers. They're just trading at a multiple. They're in the hardware side. They're in a completely different thing than this software thing of being having it out. There's so many things wrong with a 30 multiple versus a 15 right now in a world of AI that I think this new regime is starting to make the bar really high for high multiples. It's the other reason why the DAX, which has obviously gone from a 13 PE here, if you're going to say hardware is going to improve, that we need water cooling systems from Siemens, if we're going to do a data center build out, whatever it is, you're getting this multiple thing, and they don't have any technology names to make them under pressure. So if you're in a country that hasn't won the technology battle, the US won the technology battle, not having that is creating a situation. Now again, the Mag 7 will continue to be able to make money. This is not some doom and gloom picture on them. I'm sure they are. I just don't think, regardless of what their earnings are, unless there's a massive shock, that they're going to go back to the multiples they were. They'll find a bottom at some point, and when the tariff shift, you'll make a bottom. Correlated with it for now is still Bitcoin. Bitcoin's acted better than the S&P in this. It's still the same trade at this point, meaning until the Mag 7 stop going down, this thing is going to be under pressure. But as I've talked about, my favorite trade for this year is long Bitcoin, short the Mag 7. I still think that's going to work out. I would continue to focus there. Gold is highlighting to you that the uncertainty will remain. This has gone parabolic here. In many ways, it's faster than anything that happened during '09 in terms of the speed. This has just gone parabolic. And when you get this kind of a move in gold in a short amount of time where it's 50%, it means there's uncertainty out there. And I think this is going to remain going forward. The only other thing I wanted to finish with, I've talked about stablecoins being a very important thing for the network effects this year, which will benefit Bitcoin. I continue to believe, of all the technology names that you want to look at, the only one that has a moat, in my opinion, is Bitcoin. When we come out of this period, which could happen at any time, the one thing that is usual when you have this sentiment this bad, I think you have to expect a low to come in, a sustainable low within the next few weeks. It could happen on Monday. It could happen after tariffs come out. It could happen on a bad earnings report. But at some point here, I expect a low that's going to last for at least a few months, because when you get the sentiment this bearish and you get people this out, you're near a low. So I'd be looking to buy Bitcoin way over any of the tech names if you're trying to pick a bottom. That's it for this week. I will see you guys next week.